Hello, and welcome back to the Get to Know Hedge Fund Investing series. I'm Jamie Eppenberg. This is with Carl and the Carl Investment Platform. Today, I am going to talk about, and I hope to keep it brief today, about one other type of investor who, and this may encompass, all of the investors I've talked about. Most of our investors are looking to outperform the market. Now, the savings and bond investors aside, their outperformance is on risk. And we talked about that last time. It's still a type of outperforming. A lot of the other investors are, they're looking for targeted gains to outperform. A particular type of investor in this category is I've spoken to quite a few IRA retirement investors who are not within 10 years of retirement. Now, admittedly, I don't get a lot of early 20 folks, 20 something folks looking at their IRA. But these folks still have more than 10 years to retirement, and they really do want a rainbow portfolio that can outperform the market because they're very aware that the 60-40, it will perform. It might get them there, but they can probably do better with more diversification. And that's what institutions and the uber wealthy, they've had access to that for many years. And that's what hedge funds, historically are supposed to be able to do. And that's why people invest in them, right? To take the edge off of downturns in markets, to be able to outperform the market, depending on, what the markets are, but more of the time, and keep more capital, more invested dollars working. So we have investments that historically have done this. Now, these are the strategies that Carl investments are based on when you look at the history. And I'll talk about that more when we go through each investment, because the Carl history is still only a year or two old. Historically, when you look at the statistics in the Carl mobile app, and I'll go through where that is, you're going to see that we have funds that have outperformed the market more than 1 year over, let's say. Now, I have to mention, for regulation, you have to understand that historical statistics or historical performance is not always indicative of future performance. That's true of any investment. While we are often looking at historical statistics in order to determine what's going to be the best fit for our own portfolios. So we're still going to talk about the historical stats. So when we talk about this, what's important to consider is, if you're looking at hedge funds to diversify your portfolio, are you looking for one? Is it the right thing to do to just pick one hedge fund as your diversifier? While we would encourage you to take a look at a diversified hedge fund portfolio and see how that could perform for you over time. Because when we look at the funds, putting more than one hedge fund together, and it does kind of depend on what's right for your portfolio, but putting more than one together can be pretty powerful, and it really can outperform common markets, common indexes, particularly if you've got, more than 2 years to invest. The performance that you get from a diversified hedge fund portfolio, when you look at the historical stats, can be very strong. So we encourage you to look at that and consider not just one, but if you're a diversifier and you are looking to outperform the market, look at putting hedge funds together, and our statistics will help you see, how do these perform together? What are my options if in a portfolio fashion? All right, so next time, I promise, we're going to start going through the individual funds on the platform and hopefully get you used to looking at them and deciding what's right for you.